Good afternoon and welcome to Hand's Lunch and Learn webinar. Affordable housing isn't affordable anymore when the math doesn't math. This is my kind of topic. My name is Andrea Davis and I serve as Executive Director of HAND, which is Hamilton County's Community Housing Development Organization. This webinar is part of a new Lunch and Learn series made possible through the support of the Hamilton County Community Foundation, and it builds on conversations that began at our Suburban Housing Conference earlier this year. Yesterday, we focused on the human side of affordable housing and heard stories about families struggling to qualify for housing, seniors on fixed incomes struggling to remain housed, and the growing gap between incomes and housing costs. Today, we're focusing on the development side of that same challenge. Affordable housing has always been challenging to develop, but the financial pressures facing affordable housing have changed dramatically in recent years. Today's conversation is about understanding what has changed, how those changes are impacting affordable housing development, and what it will take to continue creating and preserving affordable housing opportunities in our communities. Before we begin, I just want to remind you that we are recording today's webinar. I did remember to press that button today, so you will be sent a copy of the recording. Now let's meet our panelists who've taken time out of their days to be with us today. We have Jonathan Elke from Gratis Development, Alan Rakowski from the Indiana Housing and Community Development Authority, and Lydia Watson from Intend, Indiana. Let's start with Jonathan. If you could just briefly introduce yourself, your organization, and the perspective that you bring to today's conversation.
Good afternoon. I'm Jonathan Elke with Gratis Development. I'm the owner and founder of Gratis Development. Gratis was founded in late 2019, literally right before COVID
Good
hit.
timing.
Yeah, yeah. And in 6 years, we have been responsible for uh, the development of 15 projects, 12 LIHTC projects, and three using home, HP, or some other funding sources. Prior to that, I was also at a vertically integrated national developer. So, prior to that, I actually worked at the state housing authority. So, in my
So you got all the
15,
perspectives.
yeah, I like to think so.
Awesome.
So in my 15 years, I've seen quite a bit of different affordable housing development, but I'm very blessed to have seen so many different perspectives. Gratis is a mission-driven for-profit, so Gratis is led for gratitude. We sort of approach every project with a vision to pursue goodness and a mission that to lift up our tenants, the neighborhoods, the communities, and our partners with every transaction we do. So our goal is not always just to develop, but also to lift up communities that we're a part of.
Wonderful. Thank you. Alan, let's go to you.
Yes, thank you, Andrea. I'm Alan Rakowski. I'm the Senior Director of Real Estate Allocation at Indiana Housing and Community Development Authority. So a lot of you probably are familiar with us. We're the state entity that allocates and grants a lot of the funding that are used to create and preserve affordable housing. So I've been with IHCDA coming up on 19 years this fall. So seen a lot there. Worked with Jonathan when he was here for a couple of years.
Wonderful.
And happy to be on this panel today to share our views.
Wonderful. Thank you so much. Lydia?
Good afternoon, everyone. I am Lydia Watson. I am the Director of Real Estate Development for Intend, Indiana. And we are a nonprofit developer. And so to give a little bit about my background. A lot of my work most recently has been with United Way of Central Indiana, where I did an extensive amount of work in human services in regards to safe and affordable housing. Before then, I actually had some time with the city of Indianapolis as a home grant manager. Also did some stints at the code enforcement with business licensing, nuisance abatement, and unsafe building housing law. So kind of have a well-rounded background, and I am too excited to join the panel today.
Fantastic. Well, thank you so much. I'm the newcomer to this space. I've been at Hand 10 years this year. executive director for since 2020, but I already have seen examples of what we're talking about just in my limited time in the industry. Um, our staff went back and looked at, just as an example, right, to kind of frame this conversation of hands-on development costs. Now we do a kind of different kind of development than like Jonathan and Intend. We do rental housing, and we do deliberately small developments using funds that encourage, kind of smaller size developments rather than the tax credit development. But our first significant project in 2009, the first phase of our Spicewood Gardens tax credit development, it was 26 units, and we paid about $150,000 per unit for that. These are 2-bedroom, 1-bath duplexes in Sheridan, designed for seniors. So designed to allow seniors to live there independently as long as they're able to live independently. Contrast that with a project we have under construction right now, 2026. Home Place Duets, we're building 3 duplexes in Carmel. As you might imagine, the land was a little bit more expensive in Carmel than it was in Sheridan 20 some years ago. But that, with between the cost of the land and the infrastructure needs of the land, this is less than 1 acre. We're building 6 units, and that comes out to about $506,000 per unit. So it just gives you an idea, for those of you who don't work in the space on a daily basis, of how the economics have changed. Land costs obviously have increased. The cost of construction itself have increased. And I think a lot of folks who don't work in this space also don't understand that it's no cheaper to build affordable housing than it is to build market rate housing, right? It's the same products, the same workers. We're not building an inferior product because it will be rented for less than a market rate product. In fact, because we're using government funding, a lot of times we're building to a higher standard than some privately funded developments may. So let's talk about that. I started with the panelists saying I wanted them to talk more than me, and here I've just been babbling on. Let's start with Jonathan. Obviously the economics of affordable housing development have changed dramatically in my limited time, and those of you who have been doing this longer, I'm sure, see it even more. Jonathan, from your perspective as a developer, what do you see has changed the most over the past decade or so?
I think there's a huge transition in cost and hard cost pre-COVID versus post-COVID. And many of those have not really re returned to pre-COVID pricing and may never do so. Um, so pre-COVID, you could get projects built for much less than 500 a door,
Yeah.
right? And post-COVID, there was a huge amount of price increases across the board. Lumber famously spiked. It did come back down to pre-COVID pricing. Many of the other divisions and costs of materials never returned to pre-COVID pricing. So that's just a reality of things, much like everything else, groceries or um, gas or other costs that have just never seemed to have come down. So that's by far the biggest one. Other things that we've seen increase are just operating costs, increases in salaries, increases in insurance, and things like that. So basically, it's just a lot of headwinds from a lot of different directions.
Yeah, it's kind of amazing that anyone who wants to make a profit actually does this work, right? Um, Alan, looking across Indiana, are you seeing these same pressures everywhere, or are there regional challenges that you see in certain areas, or what do you think the biggest impact is on projects today that
Yeah, I think it's everywhere. There's some parts of the state may have more challenges than others just because of the labor market that they're in. But it's I think statewide, and I think we rely on developers like Jonathan to let us know what those costs are. We see them in an application, but I would agree with what he's saying. We're seeing material costs, hearing a lot about also just labor shortages, that there's not enough contractors to do the work. There was a period where there wasn't, you could have there was contractors would take any job that they could get, but I think they can be a little bit more selective now. So that also impacts timing and how quickly things get done. As Jonathan mentioned, insurance cost increases. We've heard a lot about those, especially for in our existing portfolio, that they just really have taken off quite a bit in the last few years, making it so that it's hard to be able to maintain the affordable rents. And also, acquisition price is kind of a wild card. I think that depending on where you are, and Andrew, you talked about it, like if you're going to be doing something in Carmel, it's going to be vastly different than what you're going to find in rural Indiana, and it feels as if the pressure upward just continues on prices to do development, unless it's a situation where maybe you have a community partner or a city or a town that has the land that's going to get it to you at a discount. But I think those costs continue to go up as well.
Yeah, you're jumping ahead to solutions, but so we'll definitely get there for sure. Lydia, from the nonprofit and community development perspective, what changes are you seeing that keep you up at night?
Yeah, so I would have to agree with both Jonathan and Alan. And Intent is statewide, so we're in different markets, not only the Indy market, Shelbyville, Muncie, South Bend. So I would say across the board, it's definitely an increase in labor costs. I can give an example, construction. I could give an example. So in 2021, for pretty much the same build, we spent maybe 210,000 to get that one, completed. That same today is costing us around 290,
Oh, wow. Like
290.
literally
So
the same house.
it's the same. It's the same
Yeah.
house. I would agree that finding the land, right, is kind of what Alan was speaking to in these different markets. Yeah, sometimes they're donated, sometimes they're not. Sometimes you're working with a private seller. And then as a nonprofit developer, we can't help but keep that buyer in mind. And so it's getting harder to find a buyer, right, that can afford the affordable unit,
Right.
and getting that education out there. So while that's not necessarily a hard development cost, it's something that as a nonprofit builder, we're also seeing that, wage hasn't increased, livable wage hasn't increased in
Right.
quite some time. So those
You
those
can't
things
build the house that
we
you're
don't have a buyer for.
right. That makes complete sense. I think from the community development perspective, at least from my perspective on it, the other thing we haven't talked about is the availability of funds,
Yeah.
right? Like, obviously private financing is available and it is costly, but one of the ways that we're able to make these projects work math wise is the ability to bring in funding that doesn't have to be repaid
Hmm.
or can be repaid in a more favorable
Hmm.
manner than your traditional bank funders. So um, how as costs increase, the resources available to pay for them are decreasing. How much of that is a concern for you all at Intend, or even Jonathan? You're a for-profit developer, but you obviously rely on some of these
Yeah.
tools as well.
Um, Definitely. I mean, I think it's definitely a concern, something that our leadership is always watching to see what we can advocate for. They're always kind of like, if they can have an opportunity to go to the
Legislature.
legislation, yeah, they'll be there advocating for us. But I mean, really, our job now is to layer more different types of financing, because that subsidy that used to really help close a gap is no longer closing. So it's really about getting creative with, can I put home in this deal ready? And that's really just a kind of like got to get some creativity to do
Sure,
that, to make
sure.
it, yeah,
Which
financially
is actually
stable.
a wonderful segue to the next issue that I want to talk about. The pressure on project feasibility and how where our initial Spicewood Gardens project maybe was tax credits and a little bit of home and done, right? And now we're multiple sources of funding in each. Um, but before we move to that, I wanted to reflect just a little bit on the cost increases, and just try to kind of connect the dots for folks again who don't work in this industry on a daily basis. Is in the for-profit market rate world, as your project increase in costs, that you are able to pass those on to your customers, right? You go in and you want to build 500 units and the town tells you can only build 400. Well, those 400 units just got more expensive because, you're going to make the same amount of money at the end of the day. But with community development, we don't have, we are dealing with restricted rents, and there are, limited ways that we can absorb the impact of these cost increases. Which ones have been the most difficult to kind of figure out how to deal with as you've put deals together? And we'll just go around, maybe start with you, Lydia.
I'm sorry, could you clarify that?
Yeah, which cost increases have been the most difficult
Oh,
to absorb as you're
yeah. Hmm.
and the hardest nut to crack, right? Like some of them you just get more money, but others it's like,
Yeah, it might be. I would say the acquisition piece, probably. I would say acquisition.
yeah, that's a tricky one, right? Because
Yeah, that would be the
doing
tricky
and
one. Yeah.
yeah,
Yeah. Um, yeah, because there are times where strategically we're trying to get as many as we can, and then there's holding costs, and then the time it takes to actually get development started. So there's also all these other different like financial pieces that
right.
comes with acquisition
That
as
you
you're
aren't
waiting for funding.
necessarily
Yeah, so
getting
you
paid
can't
back for.
always, it's not like we're flipping. Like you could just buy a property, you flip, you get it back on the market. It's a process. And so
Right.
there's fees that are accruing in that time as well.
That's an excellent point.
Yeah.
Jonathan, do you have a similar experience? Are there costs that are harder than others to figure out?
I think interestingly enough, some of the hardest developments that Gratis has worked on have been the smaller ones. I think when you're doing 11 units, home HP funding, the
Yeah,
economies
you
don't
can't spread it.
translate,
Yeah,
right? So you have a smaller pool of contractors willing to look at that project. Um, so we've been able to leverage relationships to get those smaller projects over the finish line. In every case, literally the only reason those projects moved forward was a strong relationship with the not-for-profit that we're developing for and a contractor in the city,
yeah,
right? So in Indianapolis, we are doing 11 units for Shepherd Community, and their director has a very strong relationship with the VP of construction at Flaherty College.
oh, nice.
So, and because of that, Flaherty understood this is a mission-minded project, so they took a haircut, asked subs to take a haircut, and that was the only way we got a buildable budget. Same thing in Davenport, Iowa. The GC that was able to make it was literally hundreds of thousands of dollars lower than the non-relationship GC. So that was
Wow.
extremely difficult. In the case of the majority of our projects are using 9% tax credit financing, and we just tend to be a lower unit count. We'll be at 46 units when I think the largest project I did was in 2017, 73 units with one allocation of 9% credits. Those days are gone, and that's kind of sad, right?
Yeah,
So that's a loss of 30 units with the same amount of funding,
yeah,
right?
yeah. It's kind of scary, but
Yeah.
that's why we have to preserve what we have, because when those come out of affordability, imagine how much it's going to cost to replace them. Alan,
Hmm.
are you seeing this? I'm sure, as developers run into challenges with funding, IHCDA is one of the first folks they probably turn to, like, hey, what do we do? Where can we get more money?
Yeah, it's most deals do have a gap, and we work to make some recommendations. And we do have some sources. We have our development fund, which is a loan program. It's a state resource that we're able to offer it at a low interest rate. But it is a loan that has to be paid back. But we can work favorable terms as far as that being a additional source of the $500,000, and then also depending on if there's a not-for-profit, they could potentially request home funding. Also, if it's a supportive housing deal, they can request housing trust fund. But I guess the challenge then is for these sources to be included in an eligible basis, it had to be structured as loans essentially. So
rather than
that
grants.
the days of just a grant to make these deals work, you still see those, but it could in fact impact how many credits you get. But yeah, it's very common for us to have deals come to us and say whether we do you know where else we can go, and unfortunately we don't have a great answer. That oftentimes it's talk to the local community if it's a larger city, if they have financing that might be available. AHP is as the partner we work with a lot, that a lot of the deals also go to. But um, yeah, it seems like the gap is something most deals are working with, and there could be quite a few that we just don't even know about because they don't even get that far. So
Right.
I think we have an idea of which deals are struggling to find gap, and then but we don't know is all the deals that just don't even
Don't even
get
get
close to us,
yeah.
and that's something we never really get a grasp on. But I think the more we talk to our development partners, we get the better idea we get on that.
I think it's also interesting to note that each of these funding sources that we've talked about, AHP, which is Affordable Housing Program through Federal Home Loan Bank, the home program, tax credits, they each have their own rules and regulations that sometimes go together and sometimes conflict.
Right.
Or layer on, for example, the home program, if you build more than 11 units, which most tax credit deals are going to be more than 11 units, then that adds on a prevailing rate wage legislation that our contractors tell us is going to make our projects more expensive. So it's kind of counterintuitive of how it all works. But let's talk about the need to diversify the capital stack. Hands projects, as I mentioned, we are deliberately keep those on the small side to avoid the prevailing wage legislation, to be honest. So our capital stacks are much simpler than I'm sure Jonathan deals with and Lydia as well, where our main source of funding for our projects is the Federal Home Program. It looks like an acronym, but it's not. Then we're able to layer in some local community development block grant funding. Hamilton County is a large enough county that it gets its own allocation from HUD, and affordable housing has been made a priority. So we're fortunate that we're able to use CDBG funds largely for property acquisition. There are some rules around what you can use each of these pots of money for as well. Then we typically have a private loan and usually ask the state to help with a development fund loan as well. In 2020, Jonathan talked about the difference COVID made, and that's really sort of we had a project that straddled that COVID era. We started out with about a $3 million proposal to build 11 units in Fishers. COVID hit, and it turned into a $4.7 million project to build 11 units in Fishers. Between the time that we submitted our application with the budget and the funds were released, that the costs had increased about a little over $1 million. So we had to go back and figure out how do we find $1 million and work it into our pro forma so that we're not increasing the cost of our debt over time. We were fortunate. We have a really great relationship with our community foundation. We reached out to actually ask for their help in another way. And they said, well, how about if we take out your private loan that you're paying 7% interest on? Because that was the big COVID era change, right? Interest rate. Instead of you paying a bank 7% to borrow $1 million, how about we loan you more at a lower interest rate so that your payments remain the same? And that was an impact loan they were able to do because they had donors who wanted to make a philanthropic investment in the community and see a return on their money, but not necessarily as much as a return as they would get with investing in the stock market or whatever. And so that was kind of a creative option that now we start there. Like, can we get an impact loan? Because boy, that 3% is a lot more attractive than what banks are able to provide now. So as projects increasingly require more funding sources, more layers, more partners to become feasible, they become more complicated. Alan, have you seen, and I think you've touched on this, the amount of subsidy and financing needed to make affordable housing projects it's the amount needed seems to be going up, but the amount provided, not necessarily so. How has that, relationship changed over time?
Yeah, so unfortunately, some of the federal sources they're not at the levels they used to be. So it's just I give developers credit there trying to find that somewhere else, and that we just IHCA is limited on what we can do as far as those sources. So
Sure.
I think overall we see fewer projects that do have home funds, fewer projects that maybe have housing trust fund, and at the same time, more projects asking for development funds. So it was that, as I mentioned already, that's a pretty popular source that maybe 5 or 6 years ago, you'd have a third of the projects, maybe less than that, request development fund. But now you have probably more than half that are relying on that development fund loan to make the deal work. And
And those
fortunately,
are much lower
yeah,
rates typically.
right, lower rates. And fortunately, that's a resource that's been pretty steady for us as far as having that availability. Now, if we didn't have that, it'd be a challenge, I think, just because we don't the federal sources, some of the other sources out there. We kind of have to go with what's happening federally, and if it's cut, then it has to be developers have to find another way to fill those gaps. And we don't, like I said earlier, we don't always have really a go-to for that.
Jonathan, from your perspective, what does it take to move a project from concept to construction when you think about all these different financing pieces? I mean,
Um, we just try to be extremely thorough from day one. We're very conservative already, so we'll get, estimates at the very beginning conceptually, again halfway through, and at the end I'm gonna go out to bid. One good thing, despite all these headwinds, I feel like things have really stabilized. Um, we've seen insurance actually come down a little bit in the last year from 2024, in some cases pretty significantly. So I think that industry is stabilized. And as high as they are, prices have stabilized, in my opinion. I'm able to get pricing from a contractor estimate, you know, end of last year. And when they went out to bid in May, we were relatively close, which is something you could not rely on in
sure.
2021,
Yeah,
2022, 23 even. So I'm thankful for that. So when you have tools you can rely on, contractors, relationships you can rely on, we just start scrubbing every detail from day one, to be very, very conservative so that we can do what we said we would do when we applied to a state housing authority for funding so we can execute because of all the diligence we did on the front end.
makes sense. Are you able to, Lydia mentioned building the same house today costs, $70,000 more than it did a couple of years ago. Are you able to replicate your product so that you can do that type of comparison, or are you building something different every time?
Yeah, we're not big enough yet to get, but we're starting to try to say, hey, this is a floor plan, a building plan that was really beloved by seniors. So we'll try to take that, make some tweaks. And I think things like that are good. Everybody saw the big housing bill that passed, and one of the efforts was to kind of lower barriers to modular or housing, which I'm a fan of. I just think that, if you're building the same floor plan in, Sheridan as you are in Greenwood, there's nothing wrong with that, right?
Yeah, right,
So if we can get more efficiencies in the industry, I think that's a great thing.
for sure. Lydia, from your perspective, where do partnerships and creative financing kind of fit into the whole?
Yeah, they are extremely important. So I can think of a few examples. So you've already mentioned kind of like philanthropy, government support. So whether it's even if it's not direct funding. So for example, with South Bend, that partnership has been critical because they are helping us with the lot acquisition, and these lots are already ready for the most point to be developed. So we do try to advocate for land banks, where again some of that environmental work or pre-construction work, or even utility connection is done, and we don't have to put forth the costs
Right.
in that way. So for example, with South Bend, there are times where we are doing the utility connection, but then they have a program that reimburses us
Oh, nice.
for doing that type of work. So partnerships like that are key. Being able to leverage, other nonprofits in the area. is key. I think some of the other things Jonathan also mentioned that we're looking at doing is, realistic budgeting from the start and
Right,
trying to build in contingency, especially when that construction is in phases. So when we've committed to a large number of units or homes, taking that in phases.
right. And knowing the
Um,
costs are going to increase between phases.
yeah, knowing that, yeah, they're going to increase. And then also, we're a nonprofit builder, but we have also done some mixed rate in some of our communities to help kind of,
Yeah,
you know, it doesn't always consume what we needed to do, but it helps close that gap a little bit.
for sure. And I think that's one of the things that a lot of folks in the public don't really consider is, like, for example, our Cumberland Cottages project in Fishers, I mentioned, was $4.5 million. In order to get that pro forma to work, we had to make, of the 11 units, 5 of them are not affordable. They're market rate units. There are market rates, and the market's market rates are maybe not an exact match, but we needed the revenue from those market rate units to pay
Right.
for the loans that we needed to build the affordable ones. So
And
that,
I must say, we're not going any cheaper on the development for the ones that are affordable.
no, no, it's the exact
It's the
same,
exact
yeah,
same.
exact same product. It's just who
Yeah.
pays for
Yep.
what. And
Yeah.
yeah, I know if we were developing Cumberland Cottages today versus starting it in 2020, it would be a different product just because,
Yeah.
we can't, the first thing we said when we got done with that is, well, we can't do that again. That was way too expensive of a project. So it's you have to get creative and think about how things
Mhm.
can change. Alan, are you seeing projects change as a result of this pressure on pricing, downsizing?
I think, yeah, I think I agree with Jonathan. I think maybe some smaller projects, not as many units. It's it. I would also say that maybe the number of deals we see now. We'll find out here in a month in our tech competitive tax credit rounds how many applications we get. But if we just look at kind of our pipeline of we also have a non-competitive bond round that's usually for like larger deals. But the number of applications we've gotten in so far just is down a little bit from where it was this time last year, and we don't know if it's again because it costs, or there's also the concern about equity pricing right now in general for those that are putting deals together. The equity market's not as strong as it was previously. So, but I think we are seeing just kind of scale back to some degree as far as number of units, and we've tried to help at IHCDA as well and some of our QAP requirements to try to be sensitive to some of the costs. And it one thing I do want to mention we did, when we talk about units, we did remove the minimum unit size requirement in our QAP, which a number of states have done that, and we looked at it and we thought that this could be something that's driving costs that we don't really know necessarily where those minimums came from. We've had them in our QAP for many years, so um, I think that's part of our approach to seeing that the environment's a little more challenging, that the projects are smaller. What can we do as an agency to help offset some of that? And that's some of the things that we've done, and I think we're going to continue to try to do as we look to work on our policy again for next year.
That's wonderful. I think one of the things as a developer I appreciate is the state hasn't, it'd be really easy to say the pot of money we get from the feds is shrinking, so we're going to make smaller awards to the same number of people. And I
Mm-hmm.
think the state has acknowledged, like, it's getting hard, it's harder than ever to make these projects work. And so when we support a project, it needs to be a meaningful level of support, not
Right,
we'll give everyone $10,000 and wish them luck.
right. Yeah, and
The
I
per
would add,
unit subsidies have increased.
right. And we were fortunate in last year's that the big beautiful bill, there was an increase in the 9% credits and the amount that are being available, being allocated. So that was great. That was a big win. But I think part of the challenge there is there's just more credits out there, and maybe the appetite from investors. There's more to choose from. So that could be part of it as well. Just that you have more credits, but then you still need to have the tools that make this program work. Be just as I think ready to be at the table to make investments into these properties.
For sure. We've
Yeah,
talked a little.
I'll
I'm sorry, go ahead.
piggyback on that. Just in the life tech world, there's an increase in the allocation of credits, which we all celebrated. However, just basic economics, you have a higher supply, demand stays the same, right? So pricing dropped pretty significantly over the last year. And given how many 4% deals and lot of tech deals that were out there, investors are now cherry picking best of the best. And granted, even though we're 6 years in and we've done 12 live tech deals, we're still seeing kind of as a little developer, and it was quite a bit. There were a number of investors that wouldn't even look at our deals,
Hmm.
um, not in a spiteful way, just like, hey, if they're working with a massive developer with a big balance sheet, it's much easier for them to underwrite that and allocate credits to that deal. So that's an interesting byproduct of an increase in credits is just a smaller pool and actually a much more competitive equity market out there.
Yeah, interesting. Lydia, are you seeing the pressures influencing the types of projects that Intend is moving forward or the partnerships that are needed to make them successful?
The types of projects, I would say not so much. I mean, we're kind of staying in our wheelhouse. I mean, we're home ownership, so we don't do
Yeah,
any rental projects. And our history, there's been some
sure.
it's in our history, but it's
We
not.
all dabble, right?
Yeah, so I think that I mean we're kind of sticking to, what's been working with us as far as like projects. Yeah, it really depends on where we are at on the breadth of that project.
Sure.
So South Bend is up to 90 homes over the next 4 years. And Richmond right now it's maybe 22. So it just really kind of depends on where we're at. But it's the
Right.
same type of product that we're putting in these different places.
I would think that would add a little stability to your pro forma and
Yes.
your
Yeah. Yeah.
financial
Yeah.
projections.
Yeah.
We all aspire, Jonathan and I aspire to get there. We're like, this is what we
Yeah.
build, take it or leave it. No,
And we do strive to go local. Like when we do go in those spots, and when we're talking about contractors and developers, we do partner with local to
sure.
help with that as
Yeah.
well. Yeah.
Yeah, I'm fascinated by Jonathan's anecdote about the bid coming in hundreds of $1,000s lower because of a relationship.
Yeah,
So
that's
yeah,
amazing.
I yeah, introduce me, please. Yeah, I mean, I think
Introduce
there's
us all.
right. That's the problem is you find one of those and then we ruin it for everyone. I think there's no doubt that there are projects that maybe were feasible 10 years ago that just don't pencil today. And so that's our challenge, right?
Yeah.
Is to figure out how to make things work. Jonathan, you mentioned insurance. I'm encouraged to hear you're seeing some movement in the right direction. Our insurance premiums, as an example, we have a 9 unit property in Noblesville in a golf course community, 2 bedrooms, attached units. In 2013, our annual premium for that property when it came online was $2,800 a year. This year, the premium is $4,300 a year. Um, our insurance brokers tell us that insurance companies don't like wood construction. They prefer the metal, you know, podium buildings. But, you know, that obviously speaks to operating costs, ongoing sustainability of properties because our rents are restricted. Um, you know, we have the continued challenge once we get the darn things built is how do we continue to operate these with the limited income potential. Alan, I know IHCDA evaluates long-term viability of projects when reviewing them. You don't want to fund something that isn't going to succeed. What does sustainability look like from your perspective as a funder?
Yeah, so I think you're right. There's a 30-year basically period on the tax credit program. We incentivize to go even longer than that, either 35 or 40 through points in our QAP. So there's standards that have to be met, of course. This is an area where we try to, again, as far as building and certifications and sustainability, we try to balance those with cost concerns. So that's an area that you'll see. We still encourage and we promote projects that are built that may have these certifications, whether LEED, green building, things like that. But we have scaled back a little bit in our QAP. The current QAP we have is one where it's no longer a threshold requirement, but it's something that you can do, you can commit to in order to help your application in the score. So I think balancing that is something that we were trying to find the right balance. We've been kind of on the extreme end, is having these certifications be part of the threshold requirement. But then also knowing that again, that does add quite a bit of cost up front, and it may take quite some time to recoup that. Um, but yeah, I mean, we also, just within our minimum design standards, minimum development standards in our QAP, we try to ensure that things are going to be able to withstand normal wear and tear, so that a deal can come back after 15 years to get resyndicated, but ideally they should be able to last longer than that. And it depends on the product that you have, but at the very least they'd need to be able to go at least 15 years before they would come back for a new allocation. So it's it's a balancing act, I guess, is what I'm trying to say, as far as making sure that we're making sure that these projects are going to stay affordable, or they're going to stay operable. Also, they're going to look like every other project. You both, I believe you mentioned that the affordable really are no different than the market. The standard sometimes is even a little higher based on some of the sources that go into it. So how do we do that? And at the same time, not make it so that we have fewer units because of the cost with that.
Absolutely. I think a lot of people don't realize when as we've all said, it's difficult to predict what's going to happen with construction costs from year to year. Imagine predicting what's going to happen with all of your operating costs, like lawn care and snow removal and electricity and insurance and all of that over 30 years. I mean, there are assumptions built into the IHCDA's pro forma, assuming that rent will increase modestly and
Right.
costs will increase modestly, but there's nothing modest about what's been happening to costs, that's for sure. On that topic, Jonathan, what operating costs are creating the most pressure for you and your partners now? I mean, I know your focus is on the development side, but obviously you have to think about uh, financial
No,
sustainability.
that's a really big question. Again, we're just very conservative. We try to actually get numbers that have a basis in reality. We'll reach out to a local utility electricity provider and just explain what we're doing and try to get some rates from them. Insurance, we have a wonderful insurance broker that we call as soon as we are looking at a project and say, can you get an estimate? And for a couple of years there, they wouldn't even give you an estimate for something that's getting built. But we're back to a place where we can get an estimate for something we're about to start construction on. Um, but I think salaries was a big one as well. I believe IHDA's minimum operating expense requirement a few years ago was something like 4,500 a door. And I was in a um conference of some sort of affordable housing. And the syndicator said they won't even look at, they assume it's got to be at least 6,200 a door, right? So that was at the insurance peak and all that. I think it's settled a little bit since then, but it's definitely very important, and we don't want to underwrite anything for ourselves or for our not-for-profit partners. Part of our mission is to provide an asset that truly is an asset for the not-for-profit. And interesting thing we do is we stress test by underwriting below maximum affordable rents. So Carmel, that might not be an issue for you, Andrea, but if you're doing, say, affordable housing in Columbus or Hobart, Indiana. We don't want to assume that our not-for-profit can attain maximum rents that the affordable housing program allows. Even those are affordable rents, they might feel a little bit
Yeah.
aggressive to me. So I'll take
In
a
that market,
discount
yeah.
on those. And that's a beautiful stress test because, if things are not operating the way they should, they still have room to be in compliance with the program, but to increase the rents that I underwrote for them. So
Interesting. Yeah, that's Fascinating. And I assume you base that on what the market is bearing in that area, right? Like
Right,
if
right.
your affordable rent is more than a market rate apartment, you've got an issue. So,
Well, I mean, give an example. So we have a 9% senior housing project in Johnson County in Trafalgar, Indiana. And the only other senior housing project that was constructed in the last few years was in Greenwood, which is in the same area and same county. But because of, all the headwinds we're talking about today, the rents they had assumed were essentially max rents, and I just looked at those and thought they were too high. And sure enough, they
gotcha.
were having a hard time leasing up. And so the investor was very concerned about that. But once we explained, hey, we're not charging those same max rents, we're definitely below that. We're in Trafalgar, which is not Carmel. We
Right.
might be, if Sheridan is in Hamilton County, so is Carmel. You're not gonna get the same affordable rent in those two
Yep.
cities.
Yep. Excellent points. Lydia, one of our challenges, obviously, we're mission based, or we're all mission based here. How do we ensure that affordable housing remains affordable and sustainable, right? I mean, it's a conflict sometimes that
Hmm.
to keep it affordable, sometimes you got to
Yeah.
make tough decisions. How do we do
Yeah, I don't know if I can answer this question all by myself.
it?
But I
Well, we
think,
can all chime in, but
yeah, I think again, when we're looking at a development as a whole project, we are going to try to use that mix, so market rate housing, mix that in there. We still try to do the negotiation with the developer. One of the things that Intent does is that we actually offer a construction loan to our developers
hmm,
at a much lower rate than they would get at a traditional bank. So that can also help with lowering the cost of construction. And that's been very successful for us. So I think, yeah, so I would say definitely if you can, like as a CDFI, we can offer that tool to contractors and developers to help get our costs lower or workable. Um, Continuing to try to layer again different finances into one project if possible. Um, yeah, I would say that, and just the expert knowledge of our staff.
right.
It helps get that done. If you've got good, knowledgeable experts on your team, then minds put together can make anything work, I say.
Gotcha. Absolutely. Very good. Alan, what keeps you up at night thinking about what we're talking about here? I mean, you're, I think, in an enviable position that your paycheck keeps coming regardless of whether our deals
Right.
get funded or not.
Right. Yeah. I mean, I think the concern is, I mean, everything we hear is that there's like there's just a real shortage. There's a housing crisis. What happens if developers just start walking away? Like if they realize that like the kind of the topic, the math doesn't work anymore. That they realize um, that it's just it can't be done, or that it's more challenging for it to be done. Another thing I think is critical, we haven't talked about too much today, is just rental subsidy. I mean, that's oftentimes what can help make these deals work is if there's a rental subsidy, especially if you're trying to if you're targeting those at the lower AMI levels. That's oftentimes pretty essential for these deals to work. So I think we as an agency worry about just developers. Will they still will the resources be there? That we're fortunate. We're fortunate. We have the Light Tech program is a great program that has a lot of support, and but it's not always enough. I think is
Right.
what we're seeing. And um,
We,
so I guess the other part is just that we not only new units, but there are so many units that have been created. You talked about one, Andrea, that you have that's getting close to your 15. What's going to happen to all these after the full 30 years? I mean,
right.
it then gets every year as we get deeper into, I guess, as the program is now 40 years old, as we get every year that goes by, more units are becoming out of affordability. Then and the credits we have and resources can only do so much as far as like create new units, but also preserve those that's are really critical in communities.
Absolutely. And I think not enough of us spend enough time talking about that. The most affordable units are the ones that already exist. It's
Mm-hmm.
so much more expensive to build new than to keep what we already have built.
Right.
Yeah. If you could go back a second when you talk about rental subsidy, are you talking about subsidy to the renter, like a
Correct. Right. Subsidy that.
rental
Vouchers.
assistance?
Yeah. The rental assistance is especially critical in some of the projects that we see where your supportive housing or projects that are supporting those coming out of homelessness.
Yeah.
I mean, the subsidies are, if they're
Where
not there, these deals just don't work at all. So I think,
absolutely.
um, but then there's more projects. I mean, there'll have to be projects with those that are targeting higher AMI levels that maybe don't fit the traditional subsidy model, but they need it just as much. And
For
unfortunately,
sure.
there's limitations on how many vouchers there are, how much jurisdiction can provide when it comes to that.
Absolutely. And thank you for raising that point because that's an excellent one. It can, we did a webinar yesterday where we talked about the human impact of the math problem, right? That there are folks who don't earn enough to qualify for affordable housing, which seems wrong. But when you're focused on trying to make housing affordable and someone, it's clear are going to be spending their 100% of their income on housing, that's a difficult case to make. And that's
Right.
where rental assistance vouchers. In Hamilton County, we have over 350,000 residents. We have fewer than 300 vouchers. 300.
Right.
So, I mean, it's a huge need. I hope that's one of the things folks take away from this conversation is there is hope, right? We are all still doing this work, even though it's more difficult. We have resources like IHCDA that are coming alongside us and helping us do it. But we also need, people out in the community to recognize the work we're doing and support it with your public officials. And when there are proposals to, change things to speak up. Okay, so we're approaching the end. We're going to do some round robin questions. We'll go all around. I'll try to not pick on the same person first all the time. What is one thing you wish people better understood about affordable housing development today? And we'll start with Alan this time. So one thing you think you wish people understood.
I think, and we talked about this a little bit at the beginning, but just the cost now, like the cost per unit. I think a lot of people that maybe don't work in the industry or don't do this day to day hear, okay, you're going to be building affordable housing on the rental units, and the rental units are going to be 400,000 per unit. I hope I want I wish people understood that that seems like a lot if you compare it to a single family home. Maybe sure it may seem that way, although single family pricing of cost has gone up as well. But I wish people understood just everything that goes into that. And as far as the regulations that are involved in this, that this is housing that has high standards through because it does have to be housing that lasts for long-term periods.
Yeah.
So the comparison is not really a fair one, and we still get that on occasion when we make recommendations that someone say, well, hold on a second, I could build a home for half that. I don't know that necessarily is true anymore. I think that the more we can kind of educate people as to what these costs are, and it's not that we have this extra money that we're handing out to build more, to subsidize more than that's needed. Oftentimes, that's still the
Basics.
absolute minimum that's needed for the deal to get done. So
Yeah. Yeah, we people see our per unit cost and are like, "What are you using, granite or quartz or whatever?" It's like,
mhm,
no, we're putting in drainage and we're solving this neighborhood's drainage problem
right,
because we're the developer and that's we're
yeah,
we the six units we're building in Carmel on less than an acre. That land cost us $350,000. Well, when you spread that
right.
over 6 units, yeah. So I just keep talking. I can't stop myself. Lydia, what do you wish people better understood about affordable housing development?
Yeah, I would also agree that, understanding the costs. And I think holistically, affordable housing is community development. Affordable housing is like economic growth, like it stirs economic growth. And I think sometimes we may put affordable housing like to the side. Like it's just something we doing for the kindness of our hearts, which it is. It's very much needed work. But it's like it's also an economic tool to
Mhm.
Absolutely.
stir the economy. And when you look
Yeah.
at your most vulnerable or those that don't make as much, when you can lift them up, you really are lifting everyone up. So that's my two pieces.
Excellent. Jonathan, you want to chime in? What do you
I
wish people
think
better
just
understand?
everything we talked about on this forum, just that there's a lot of headwinds out there. Um, and it's very extremely difficult to get it done. And so just being thankful to IHCDA, local partners, and just really appreciating everybody that can support the project, whether it's helping with getting zoning approval at a city council meeting, all the way up to IHCDA providing funding to build the building. So I think lifting up partners is just important and critical to maintain support and tailwinds for affordable housing development.
Absolutely. See, I knew we asked you all to be on here for a reason. It's giving me hope knowing that we have such great folks working on this. Not necessarily tied to this conversation, but just when you consider the community development space right now, what is one thing that gives you hope moving forward? And Jonathan, we'll start with you this time.
Uh, Seems my last answer, I'm always encouraged by the amount of support we are able to garner with relationships, using strong relationships from day one has really helped us create affordable housing that everybody's excited about. And in so many cases, projects wouldn't have happened if it weren't for some relationship that existed at some point in the development. So I'm always hopeful by the goodness of people, and I just have a lot of gratitude for that.
Awesome. Thank you. Lydia, we'll go to you.
Yeah, I would just say I would add the resilience of communities, that, even though we know that there's, all this difficulty we've been talking about, just, I guess for me, it's seeing that one family walk into their new home, that mom and that child,
Yeah,
who didn't think it was possible. That keeps me coming to work every day.
absolutely. You got to celebrate the wins for sure.
Yeah, celebrate the wins.
How about you, Alan?
I think it's similar to what Jonathan said. I think it's the people and the passion that we see. I mean, we have a lot of partners that do this work. Many that have done it for many years. There are a lot of people in this industry that have been alongside of you for a good chunk of it, and you know that their hearts are and their efforts are in the right place. So I think that gives me hope. And then also, whenever we get into a period where we start to revise our QAP, there's never a shortage of comments. People really do care. Our public meetings are well attended. I mean, that always gives me hope that
Yeah,
maybe the day that stops happening is that's what would keep me up if we didn't have that I guess
for
passion
sure.
from our partners. So
And that should be coming up, right? Are we at the end of a
we
QAP?
will start. Yeah, beginning of next year is when we'll start that process again. Right.
Excellent. So here's an engagement opportunity for everyone to
Right.
plug into that and provide comments. Very good. Well, thank you all. Thank you to all of our panelists, and to all of you for sharing your time with us this afternoon. Today's conversation highlighted that affordable housing is becoming harder to finance, build, and sustain as costs continue to rise and projects require more resources and partnerships than ever before. Understanding those realities is an important part of understanding the housing challenges communities are facing today. Thank you so much for joining us and being part of the conversation. Have a great afternoon. Thank you so much. All
Thank you.
right. Thanks. Appreciate you.
Yeah.
All
Thank
right.
you.
Thank you
Thank
all.
you.
Good to see you.
You too.
Yes.
Yeah, you as well.